Hi, I'm Jeff Hirsch. I'm here with Rick Bensignor with InTheKnowTrader.com, and Rick's a real academic with behavioral finance, but also practical. So tell us what behavioral finance is and how you're bringing it from the institutional side into retail for people.
So behavioral finance is actually one of the hottest topics on Wall Street these days. It's the combination of neoclassic economics with psychology. The psychology part was always the missing part to classical economic models. It's why so many times an economist, or actually think of any econometric model, assumes that you collect data, you go through it, and that the human being will always make the perfect rational response to the data.
Really?
And
human beings perfect and rational?
Yeah, not true at all.
Not the way I realize.
So this whole school of behavioral economics has really been in the forefront for almost the last 20 years. You've got 4 now Nobel Prize winners in behavioral economics, including just October of last year, Richard Thaler of University of Chicago.
But it's really been like on Main Street and Wall Street, it's been something that's been talked about in the mainstream media that everyone's knowing about, that everyone's hearing about now.
Everybody's hearing about it now, and especially when you think about it in terms, I do a lot of private consulting to financial advisors. I'm actually a performance coach for them, and we talk a lot about behavioral finance as it relates to private wealth management. The conversation with clients now is taking on a very different tone as behavioral finance becomes more and more recognized, that the old-time interview process that an advisor would have with a new client doesn't quite cut it anymore. There's different ways of thinking about that relationship.
But people can also, that trade themselves and that invest for themselves, they also have their own biases, their own behavioral finance biases.
Guess what? We're human.
We are human.
And there's nothing we can do about it.
What's an investor's worst enemy?
Themselves.
Emotion.
Yeah, it's their own emotions.
So you were telling me before, there's one really well-known behavioral finance, bias that people fall into. It's a sort of a trap. So tell us about that.
All right. So one of the things we've done is taken the academic approach to behavioral finance and actually figured out how to make money with it in the markets. Very few people have been able to make that transition from academic to practical. So let's take, for example, this bias called anchoring. Right? It's often that your brain kind of associates to the first piece of information. Use this as an example. You buy a stock at $40 a share. We know that virtually every human being is going to make every other decision they make about that stock based upon the fact they paid $40.
That's their value basis.
Right, but it should have nothing to do. The classic economic model would never refer back to where you bought it.
Look at the stock and say, would I buy it today or would I sell it today?
Right,
people
exactly,
don't think that way.
Right? So we know you're stuck at $40. If it goes to 45, you're happy. If it goes to 35, you're not. So we not only we can't figure out any individual's anchor point, because we don't know
for a stock, though.
Right, for an individual stock. I don't know if you bought IBM today. I don't know if you paid 165, 172. I don't know where, but we can figure out collectively where the market is anchored. We've been able to create models that tell us where the emotion is going to build up and where the shift in psychology is going to take place, so that we can exploit that anchoring bias.
Use the recent sell-off in the stock market. Let's call it the Dow S&P.
Sure.
February 8th, February 9th, we had that moment where it bounced off of the 200-day moving average. Tell us how that relates to behavioral finance and how that can explain it to me.
All right, so we got our clients hedged beautifully at 2,800. We avoided almost the entire decline. We told them cover half the hedge at 25.62. That's 1% from the low from a variety of models we use. Now, the fact that it happened to be down by the 200-day moving average, that was a piece of the puzzle, but I would never
What was the behavioral finance moment, the aha moment down there? What happened down there?
The aha moment was that thrust down that we got was real liquidation. That's the call my guy and get me out at any price.
Volume, lots of volume at that one price.
Down in about a 1.5% range in the S&P, which, look, we sold off over 11% peak to trough, so 1.5% is a small amount of time of value to see just how much sell was taking place. And we had those as downside targets, and that's where we stepped back in. Look, this is all a game, right? Investing, we're all there to make money over time.
That's right.
But it's a game of trading. And what we've done is kind of figured out game theory and ways of figuring out where to take advantage of other people's mistakes.
Excellent. Thank you, Rick. Thanks, everybody.
Thanks, Jeff.